Ever wondered how you can invest in real estate without the headache of managing properties? Well, there's a unique investment vehicle that's been flying under the radar for the average investor, and it's called a real estate investment trust, or REIT for short. A REIT is a company that owns, operates, or finances income-generating real estate. Think of it as a mutual fund for real estate, pooling the resources of many investors to buy and manage properties. This allows individual investors like you to invest in large-scale income-producing real estate without having to directly manage properties. Now you might be thinking, that sounds great, but what's in it for me? Well, one of the most attractive features of REITs is that they typically offer dividends. These dividends come from the profits generated by the properties owned by the REIT. Imagine owning a piece of a shopping mall, an office building, or an apartment complex and getting a share of the profits, all without having to lift a finger. But that's not all. REITs are also traded on major stock exchanges, just like any other publicly traded company. This means that REITs are liquid investments, meaning you can buy and sell shares of a REIT anytime the stock market is open. This provides a level of flexibility that is not typically associated with real estate investments, which are often seen as long-term and illiquid investments. So, to sum up, REITs allow you to invest in real estate without having to deal with the day-to-day responsibilities of property management. They offer the potential for income through dividends, and they provide the flexibility of a liquid investment that can be bought and sold on major stock exchanges. So are you intrigued about the possibility of investing in real estate without being a landlord? Stick around as we delve deeper into the world of REITs. Now you might be asking, how exactly do these REITs work? Well, the concept is pretty straightforward. REITs operate much like a mutual fund, but for real estate. They pool the resources of multiple investors to acquire and manage properties. This could range from office buildings and shopping centers to hotels and apartment complexes. So, how does a REIT generate income? Primarily, it's through rent collected from the tenants of these properties. Let's say a REIT owns a shopping center. The businesses operating in this center, such as your favorite coffee shop or clothing store, pay rent to the REIT. This rent is then collected and becomes part of the REIT's income. But that's not the only way. REITs can also generate income by selling properties that have appreciated in value. If a REIT bought a building for, say, $1 million and sold it a few years later for $2 million, that's a tidy profit right there. Now what happens to this income? Well, by law, REITs are required to distribute at least 90% of their taxable income each year to their shareholders as dividends. This means if you're an investor in a REIT, you'll receive a portion of these earnings. Another unique aspect of REITs is that they're traded on major stock exchanges, just like any other publicly traded company. This makes them highly liquid, meaning you can buy and sell shares of a REIT just as you would shares of, say, Apple or Microsoft. It's also worth mentioning that while REITs do the heavy lifting of managing the properties, as an investor you can sit back and enjoy the monetary benefits. You don't need to worry about dealing with tenants, maintenance issues, or any other hassles that come with directly owning real estate. So, you see, REITs offer an excellent opportunity for you to invest in real estate without getting your hands dirty. Did you know that there are different types of REITs you can invest in? Yes, indeed, there are various kinds of real estate investment trusts, each offering unique opportunities and potential returns. Let's delve into them. First up are equity REITs. These are the most common type of REITs. Equity REITs own and manage income-producing real estate. They make money by leasing space in the properties they own. This income is then distributed to shareholders as dividends. These properties may include shopping centers, office buildings, apartments, and hotels, among others. The appeal of equity REITs lies in their ability to provide steady income and potential capital appreciation. Next on our list are mortgage REITs, also known as MREITs. Instead of owning property, these REITs lend money to real estate owners and operators either directly through mortgages and loans or indirectly through the acquisition of mortgage-backed securities. Their earnings come primarily from the net interest spread between the interest they earn on mortgage loans and the cost of their funding. Mortgage REITs are more sensitive to interest rate changes, which can be a key factor to consider when investing. Lastly, we have hybrid REITs. As the name suggests, hybrids are a mix of equity and mortgage REITs. They both own properties and have interest in real estate loans. This allows investors to gain exposure to both methods of income, rents and interest. However, the diversification also means they require more comprehensive management, which can impact overhead costs. It's important to note that there are also sector-specific REITs that focus on specific types of real estate, like healthcare facilities, residential properties, or data centers. These allow for even more targeted investment strategies. In essence, the type of REIT you choose to invest in will depend on your risk tolerance, investment objectives, and interest in specific sectors. Each type of REIT offers different rewards and risks, so understanding these is crucial to your investment journey. With these options, you can choose the type of REIT that aligns with your investment goals. So, what's in it for you when you invest in REITs? Let's start with a big draw: the potential for regular income through dividends. REITs, by law, are required to distribute at least 90% of their taxable income as dividends to shareholders. That's right, 90%. This can lead to a steady, consistent income stream for investors. So, if you're looking for an investment that can provide regular payouts, REITs can be an attractive option. Now let's talk about diversification. It's a word you often hear in the world of investing. The idea behind diversification is not to put all your eggs in one basket. By investing in REITs, you're spreading your investment across various real estate properties and sectors. This can help to mitigate risk because your investment isn't tied to the success or failure of a single property or sector. Diversification can provide a buffer against the volatility of the market and potentially enhance your overall returns. Another benefit? Exposure to the real estate market without the hassle of direct property management. Real estate is a popular investment choice due to its potential for high returns. But let's face it, not everyone has the time, knowledge, or inclination to manage properties directly. That's where REITs come in. They give you the opportunity to invest in income-generating properties managed by professionals without the need to deal with the day-to-day tasks of property management. It's like having your cake and eating it too. Lastly, let's not forget about liquidity. Unlike direct real estate investments which can take months to sell, REIT shares can be bought and sold on major stock exchanges just like any other stock. This means you can easily convert your investment into cash whenever you need to. As you can see, REITs can be a smart addition to your investment portfolio, so why not give it a thought and see if it fits into your investment strategy? It could be just the thing to help you achieve your financial goals. Let's quickly recap what we've learned about REITs. Real estate investment trusts, or REITs, are companies that own, operate, or finance income-generating real estate. They offer a unique pathway for anyone to venture into the world of real estate investments without the hassle of directly managing properties. We delved into how REITs work, and it's indeed fascinating. REITs pool money from numerous investors, and they use these funds to purchase a diversified portfolio of properties. These could range from apartment complexes and shopping centers to hospitals and even data centers. The income these properties generate is then distributed back to investors as dividends, providing a steady income stream. We also explored the different types of REITs. There are equity REITs, which own and manage income-producing real estate. Mortgage REITs, on the other hand, provide financing for real estate and earn income from the interest on their investments. Then we have hybrid REITs, which combine the investment strategies of both equity and mortgage REITs. Each type of REIT offers unique benefits and risks, so it's essential to choose wisely based on your investment goals and risk tolerance. The benefits of investing in REITs are plentiful. They provide high dividend yields, diversification, and the potential for capital appreciation. Plus, they are traded on major stock exchanges, just like any other stock, making them highly liquid and accessible to all types of investors. But like any investment, it's crucial to do your research and understand the risks involved. Remember, the performance of a REIT can be influenced by the broader economy, interest rates, and the real estate market itself. So, next time you think about investing in real estate, consider REITs. They might be the hassle-free investment opportunity you've been looking for.